Assalamualaikum and good day to Dr. Afza. Today I will be explaining about Case 3, the smell, taste and touch of money and accounting policy decision. Before that, my name is Amira Faizanita Amran, matric number 261035. Firstly, I will start with a brief description of the case. MIM Holding is a special purpose entity established in January 2009 in order to generate income for UPC and is wholly owned by UPC. MIM Holding is a registered management company with an initial paid-up capital of 38 million ringgit. It was principally involved in the film production, training and consultancy service, investing, holding and managing national services training program. It is one of MIM's objective and vision to become the leading strategic business in the region by year 2025, and its mission was to increase the customer satisfaction through dynamic and innovative operations. Next, the chronology of case. In 2017, MIM found an opportunity to generate more income to UPC, which is a new investment with an attractive selling price and below its fair value outside the account value. After independent valuation, the fair value of the investment is approximately 79 million ringgit. However, MIM eventually need to pay the consideration for the investment amounted approximately 50 million ringgit. It was a good opportunity that cannot be missed. Hence, UPC pushed MIM to grab the investment by exercising its control over MIM. The investment was financed through a mix of financing arrangement by making a 40 million ringgit loan from Islamic Bank and the injection of fund by the parent, which is 80 million ringgit. Meanwhile, in 2018, MIM Holdings were behind the deadline to produce a consolidated financial statement of 2018 for their parent. In 2019, the significant doubts regarding MIM's ability to continue as a going concern arose. The main issue of this case is whether the decision of recognizing the injection of fund as debt is the right choice. If yes, does MIM Holdings can repay the debt? Let's figure out together. There are three causes of problem that can be identified in this case. First, external auditor have different opinion, and then the solvency level of company and proper research are not done before making decision. The first causes of problem is the difference in opinion from both external auditors. The external auditor of MIM Holding is MJ and Associates, meanwhile the external auditor of UPC is GA and Associates. In 2017, MJ and Associates advised Aina, the accountant of MIM, to record the injection of fund as equity due to UPC is the parent of MIM. However, in 2018, GA and Associates has a different opinion regarding the recognition of fund. Instead, the fund should be classified as liability, and eventually the fund was recognized as debt. Unfortunately, after recognizing the fund as debt, the investment has not been generating enough income for MIM to repay the debt to UPC. In the end, MIM was left in despair, having now to recognize not only the 40 million ringgit Islamic banking loan, and also an additional liability of 18 million with no adequate returns of investment. Thus, we will look further into MFRS 132 in order to classify the injection of fund as liability or equity. Next, the second causes of problem is MIM did not know the solvency level of their company. In 2019, a material uncertainty related to the going concern of MIM had gained attention from the external auditor. This is due to the financial statement prepared, but which disclosed the premise upon the group has applied the going concern assumption, notwithstanding that the group has incurred a net loss of approximately 3 million ringgit during the year ended 31 December 2019. Moreover, the group's current liability has exceeded the current assets, which increased the doubt about the going concern assumption regarding the group. This indicates that MIM did not know the solvency level of their company. The solvency level of company can be determined by calculating the debt to equity ratio and interest coverage ratio. Lastly, the external auditor and accountant of MIM did not conduct a proper research. The accountant of MIM, Aina, did not dig deeper regarding the initial recognition and measurement of the injection of fund and only follows what the external auditor said, which is to recognize it as equity. This is because she only focused on getting sufficient cash in order to acquire and seal the purchase agreement for the investment. Moreover, they did not follow the article constitution of MIM, which is to not include equity other than ordinary shares. They also applied the going concern assumption to the group, even though they incur a net loss and the current liabilities exceed the current assets. Due to this, it has created confusion and different opinion with UPC's external auditor. According to MFRS 132, a financial instrument is an equity instrument only if the instrument includes no contractual obligation to deliver cash or another financial asset to another entity, and if the instrument will or may be settled in the issuer's own equity instruments. Meanwhile, a financial liability is any liability that is a contractual obligation to deliver cash or another financial asset to another entity, or to exchange financial asset or financial liabilities with another entity under conditions that are potentially unfavorable to the entity, or a contract that will or may be settled in the entity's own equity instruments. However, in this case, the parent expected MIM to repay the injection of funds from the return of the investment. In addition, a preference share that provides for mandatory redemption by the issuer for a fixed or determinable amount at a fixed or determinable future date, or gives the holder the right to require the issuer to redeem the instrument at or after a particular date for a fixed or determinable amount, is a financial liability. In this case, the injection of funds was recorded as a current liability and termed as a redeemable convertible cumulative preference shares. It was recognized in the financial statement of 2017 as to represent 18 million fully paid 8% cumulative preference shares. There are two ratios that is used to determine the solvency level of the company. The first one is the debt to equity. It is used to evaluate a company's financial leverage and measure the degree to which a company is financing its operation through debt or wholly owned funds. To be specific, it reflects the ability of shareholder equity to cover all outstanding debts. A high debt to equity ratio is often associated with high risk. It means that a company has been aggressive in financing its growth with debt. From the calculation, in 2016 the ratio is low, which is 0.79 compared to 2017, 2018 and 2019, where MIM made loan in order to pay for the investments. Starting 2017, the debt to equity ratio keep increasing, which are 2.29, 3.42 and 4.04. Next, the interest coverage ratio used to measure how well a firm can pay the interest due on outstanding debt. Lenders, investors and creditors often use this formula to determine a company's riskiness relative to its current debt or for future borrowing. Generally, a higher coverage ratio is better, although the ideal ratio may vary by industry. The lower the ratio, the more the company is burdened by debt expenses and the less capital it has to use in other ways. When a company's interest coverage ratio is only 1.5 or lower, its ability to meet interest expenses may be questionable. As shown in the calculation, MIM can pay the interest due on outstanding debt in 2016 very well. However, the interest coverage ratio started going down in 2017, 2018 and 2019 after spending on the investment. From the analysis made, it is confirmed that the decision of recognizing the injection of funds as debt is the right choice. After conducting the solvency ratio, such as debt to equity and interest coverage ratio, it can be concluded that MIM Holding is insolvent since both ratios showed a bad result, where MIM has been financing its growth with debt and unable to pay the interest due on the outstanding debt. The going concern assumption can no longer be used. In my opinion, MIM should request for a voluntary winding up, since it is proof that the company is unable to pay its debt as they fall due and the current liabilities also exceed their current assets. Winding up is a process in which the existence of a company is brought to an end, where assets of a company are collected and realized. The proceeds collected are used to discharge the company's debt and liabilities, and the remaining balance, if any, will be distributed amongst the contributories according to their entitlement. That's all from me. Thank you.